Swing trading is a style of trading where you hold a stock for a very short time, usually just a few days, to capture small moves in its price. It's like catching waves. Stock prices often swing up and down rather than moving straight up or down. Swing trading sits between day trading and long-term investing. You hold a stock for a few days or a week, rather than selling it the same day or holding for months. The goal is to buy low, sell high on those short swings, grabbing a quick profit from the next small rise in the price. In practice, a simple swing trading plan might look like this. Pick a stock that's been moving steadily. For example, you notice one has been rising gently each day. Wait for a small dip. Be patient until the price drops a bit. A short pullback. Buy during the dip. Purchase the stock at this slightly lower price, expecting the trend to continue. Hold for a few days, often 2 to 5 days. Keep the stock while it bounces back up. Swing trades are short-term, so you won't hold it for weeks. Sell on the bounce. Once the price climbs higher again, sell the stock and lock in your profit. Put simply, you're looking to buy on a little dip and then sell a few days later on the bounce. Imagine a stock that had been climbing toward $160, but then dips a bit to $126 over a couple of days. You think this dip is temporary and buy the stock at $146. A few days later, the stock bounces back up to around $280 and even a bit higher. You then sell your shares around $280, making about $134 profit on each share in just a couple days. This quick buy low, sell high cycle, lasting just a few days, is a classic short-term swing trade. In essence, swing trading is simply waiting for a tiny pullback, a dip in a rising price, and then getting out after a quick bounce. Over just a few days, you capture that small gain before the stock starts moving again. Scalp trading, or scalping, is basically making a bunch of very quick trades to grab tiny gains from small price swings. Scalpers do many trades each day, often minutes or seconds long, aiming for just a few cents of profit on each one. The idea is that catching lots of little moves can add up to a decent profit if you manage your risk. This is everything a scalp trader looks for. Quick trades on short charts. Scalpers watch very short time frame charts, like 1 minute or 5-minute charts, and focus on immediate price moves. As soon as they see a stock tick up or down by a few cents, they may buy or short with the plan to exit moments later. Speed and precision are important. High liquidity assets. Scalpers pick very liquid stocks or assets, big, heavily traded companies or markets, so their orders fill almost instantly. High liquidity and tight bid-ask spreads mean a scalper can buy and sell without large price slippage. For example, they often trade blue chip or penny stocks, forex pairs, or popular ETFs where many buyers and sellers are active. Scalping depends on repetition. A scalper might do dozens or even hundreds of these mini trades every day. Each trade only makes a tiny profit, but by repeating the process over and over, the small wins quickly add up. In the end, consistent small gains from many trades can total a large profit for the day. Let's look at a live example. The stock on screen is moving between $344 and $350. A scalper might buy 1,000 shares at $345.5 as seen right here and, within seconds or minutes in this case, sell them at $348.70, making a $3,000 profit on that trade. Then they look for another small move to trade. Even though each profit is relatively small, doing dozens of trades like this in one day can add up. For instance, making $50 10 times is $500 by the end of the session. Trend trading is all about catching a stock's longer-term move. You buy when a stock is clearly going up and plan to sell when that uptrend ends. Or you sell when a stock is clearly headed down. In other words, a trend trader follows the price. The trend is your friend. If the stock has been climbing day after day, you ride that wave. If it's been sliding, you wait or go the opposite direction. It works by first spotting a trend on the chart. Maybe the stock has been making higher peaks each day. In an uptrend, you'd buy on a small pullback and hold through the climb. In a downtrend, you might short sell. You keep an eye on the chart. As long as it keeps making higher highs, uptrend, or lower lows, downtrend, you stay with the trade. Once the pattern breaks, for example, an uptrend stock stops making new highs and starts dipping, you exit to protect your profit. Simple tools like looking at price swings or a moving average line can help identify the trend. For example, platinum futures have been rising from around $850 to $1,000 over a week, consistently making new highs. You notice this and buy some futures when it dips to $946, aiming to sell at a new high like $974. You hold as platinum keeps climbing. If it later stops rising and drops below its recent lows, you would sell to lock in gains, thinking the uptrend is over. Breakout trading means jumping in when a stock finally breaks through a key price barrier. Imagine a stock is stuck under $100 for days. That $100 is a resistance line. If it suddenly jumps above $100, that's a breakout. Breakout traders enter right as the stock breaks past resistance, or below support, betting that it will start a bigger move in that direction. It's like seeing a crowd surge through an open door. You sprint in to catch the next big wave. How it works is you first mark the stock's important levels. Maybe it hit $100 and fell back a few times. So that's a resistance ceiling. When the price closes above $100 with higher than usual volume, you take that as the signal. On a breakout up, you buy. On a breakout down, breaking below support, you sell or short. You set a stop loss just on the other side of the broken level. For example, if you buy at $100, you might stop out at $99 to cap losses if it fails. If the breakout holds, the stock often accelerates into a new trend. The key is entering quickly after the break and having a plan to exit if it turns back. So an easy example is Tech. It had been bouncing this resistance line since the pre-market. It also touched this line at the market open. This pattern is called a descending wedge, and it's a popular pattern for breakout trading. The goal is to buy as soon as the price breaks this resistance line and breaks out. In this case, it does. And here is where you would place your order. This strategy can be paired with scalping or swing trading. Gap trading is about trading those sudden overnight jumps or drops in a stock's price. A gap happens when a stock closes at one price and then opens the next day at a significantly different price, skipping any trading in between. For example, it might close at $50 yesterday and open at $55 today. That $5 skip is a gap. Gap traders look at these jumps and try to trade on them, often expecting the price will keep moving or will come back to fill the gap. This is how it works. Gaps usually happen because of news or events after the market closes, like an earnings report or big announcement. At the next open, if the stock gaps up, opens higher, some traders will buy immediately expecting the momentum to continue. Others might do the opposite. If they think the gap up is too much, they might bet on the stock falling back toward yesterday's price. This is called fading the gap. There are two common plays: riding the gap, buying on a gap up, or selling on a gap down, hoping the move continues, or fading the gap, betting it returns to the old level. Either way, gaps are volatile, so traders use quick stop losses, since gaps can reverse quickly. Here's an example. Tech stock closed at $3 the day before. Overnight, great news comes out, and it opened at around $5 today, a 2-point or $2 gap up. A gap trader could buy at $3, thinking the good news will push it even higher. Alternatively, if they feel $5 is an overreaction, they could short the stock at $5, betting it will drop back toward $3. If the stock continues climbing to $8, which in this case it did, the gap trader profits. If it falls back to $3, the gap trader losses. Momentum trading is a strategy where you buy stocks that are already moving strongly in one direction, either up or down, and aim to profit by riding that trend for a short period. The idea is that stocks showing strong recent performance are likely to continue moving in the same direction. It's like jumping on a train that's already moving and hoping it keeps going the same way. How it works: find a hot stock. First, look for a stock that's already making a big move. Maybe it's hitting new highs or climbing quickly with big volume. That's a clue that traders are paying attention. Join the move. If the stock is moving up, you buy. If it's dropping fast and you're comfortable shorting, you can short sell. You're joining the trend, not trying to guess the top or bottom. Use a stop loss. Place a stop loss just below a recent low, if going long, or above a recent high, if shorting. This protects you if the move suddenly reverses. Watch for signs to exit. When the move starts slowing down, like volume dropping or the stock stalling, you get out and take your profit. So we are looking at Tech again. It climbed around 30% already this morning, breaking its previous high. A momentum trader might buy at $5.50 as it breaks out, betting the rapid rise will continue through the day. They hold as long as the stock keeps making new highs. If it slows down, say it stalls at $6.50 or dips back to $5.50, the trader will sell to lock in profit. The goal is to ride that big move. If the stock keeps shooting up to $7 or $8, the momentum trader wins big. But if it suddenly drops, they cut losses quickly. This strategy can also be paired with swing trading, gap trading, scalp trading, and breakout trading. To make money with these strategies, you have to pair them with a decent indicator. Watch this video next to help with that.